Good afternoon, everyone, and welcome to another episode of the Dairy Signal. We're so happy you joined us on this last Thursday here in May for a U.S. Dairy Market Outlook. We're very excited to have Leonard Polzin, Dairy Markets and Policy Outreach Specialist with University of Wisconsin Extension here with us for the next hour. He's got a lot of great things to cover, so make sure to ask any and all of your questions throughout the next hour that we have Leonard here with us. As well as wanted to just say a huge thank you to all of our national partners who make programs like the Dairy Signal possible. But with that, we have a lot of information to cover, and so I'm gonna turn it right over to you, Leonard.
Well, thank you very much. Yeah, we're just going to start with an introduction here, kind of set the stage, see where things are at. I want to talk about today a few things. First, we'll see where the latest prints are, right? Let's see where some of our new production numbers are in at, things like this. But also, I want to spend some time on a lot of the stuff that I've been getting questions on. So that's high protein whey and the whey complex in general, non-fat dry milk, and then of course, right now you can't talk about anything in the dairy industry without talking about what's happening in that processor space and the processing investment, right? So I know we've touched on that before, but there's always more developments that are happening. So I think it's important to at least touch on those because they kind of are one of the biggest drivers right now that I see that is happening in our industry. So just the quick bull and bears that are out there. So on the bull side, we're having a pretty good, a big global cheese demand. Cheese exports have been strong, like we'll see in a second. We're moving product. And honestly, at the beginning of the year, that was one of the biggest questions is what's going to happen with our product? Are we going to be able to move it? All of this. One thing though, when we always talk about exports is that either there has to be a short supply or you have to be lower priced. I'll give you a guess as to which one of those two it's been so far. But nonetheless, we are moving product. It does keep up that floor a bit. On the other bull side is again, this could be on the bull side or the bear side. I mean, flip a coin and take your pick. But the processing investment in the United States. So right now, the count that I have is we're at $12 billion in processing. And of course, all of that isn't new. Some is sunsetting old plants, some is investing in efficiencies, things like this. But nonetheless, once you get to that number, it's still a very large number. And there's no way that it doesn't have some sort of structural effects, which we'll kind of talk about and dive into here a little later. Also, the dollar has been in the dairy producers' favor. So lower cost US dollar does boost exports. And that's helped here some. Hopefully it helps as we look to book exports kind of going forward too. And finally, on the bull side is limited EU production growth. We've seen that they've kind of leveled off. They have kind of in this winter here, they have increased some. That was one of the bigger drivers in the world marketplace as to why we were seeing some price pressures because they had more product than they did for a while. But I think, we're kind of leveling off, kind of in range, things like this. On the bear side, so butterfat, we have a lot of butterfat. We're very good at producing milk. We're very good at producing components. And as we're getting more cheese coming online and all of these things, we have ample supply of butterfat. So the question there becomes, are we outpacing demand? The next is, and this one, again, this is a toss to see if it's a bull or a bear, but heifers right now. Heifers, they are, I wouldn't use the word expensive, but they do cost more right now than they have historically. We'll go through kind of some numbers on that and look at kind of where I see the math falling. And I guess as fair warning, I'm a bit contrarian to a lot of folks on that. But we'll dive into it and see there. The other is Argentina and New Zealand are expanding some of their output. So we have some other global competitors in the world that are looking for that export space. And not really a bear, but more of a proxy indicator is that early in the year, we did have some DMC payments And as we're going forward here, it doesn't look like we'll get much more, but we did see some. So, all right. One thing I like to always do is just kind of set the stage. Let's see where things are coming in at. So, one way I like to do that is the USDA ERS supply and utilization report. So we'll look at production, exports, domestic use, and ending stocks. Those four things, right? And then we'll do this kind of on the class 3 side and the class 4 side. So class 3, of course, is cheese and whey is what's going to drive that. So the big question is, well, what's happening in cheese? Production, we are up, right? And we're going to continue to increase. Why? Capacity is coming online. We're going to skip exports for a second. Let's look at domestic use. Domestic use, by and large, we're down a bit for March, but on the year in total, we're within range, right? Year over year for January and February, we're in the positive range. We've just slipped a little bit below here year over year for March on domestic use. So, more or less coming in as expected. Ending stocks were this year more or less even, right? I tell folks that if you're selling into a class 3 market and you're looking for one indicator to track, that would be the one that I would choose is ending stocks. Because we kind of know that domestically, we're likely going to be within a range, right? I don't see anything that's really out there as a big unknown that's going to change our domestic cheese consumption, right? We know production is going to increase, so we need to essentially follow the residual. What's the residual? Ending stocks. So if ending stocks are staying more or less flat, it means that they're going somewhere. That somewhere right now happens to be exports. So March year over year was up 28.6%. That's a big increase, right? And as we look to January and February, so pretty much this first quarter of the year, for each of those months year over year, we have been to the positive. So where's our cheese going? Being exported. So right now, we're right around 10% of cheese production that is exported. I think the number is exactly like 9.5%, I believe. But we'll round up, we'll call it about 10% of our cheese production is exported. And then that also means that a lot of the new processing capacity in cheese is going to have to be exported as well, right? So that's why I'd say I'd watch that residual number ending stocks on that class 3 side for cheese. The other portion of this class 3 complex that is complex is dry whey. So this is your in this graph generic dry whey. We're going to break it out a little later to figure out kind of all the moving pieces here. But production has increased as we would expect because cheese production has increased. Domestic use looks down for March. I would not put a lot of weight on that at the moment. Because as we'll see in a bit, I think you need to break out the complex a little bit more in order to better understand that domestic side. So that kind of takes us to this ending stocks. And again, I think that's a good place to look at is the residual, what's happening. Our ending stocks are more or less flat for the year within, we'll say, normal range, right? So again, where is all of this going? It's going into exports. Our exports on this whey portion have been solid. And again, this is the generic commodity whey product. So what's really holding up that class 3 side? Exports, right? So if we're looking at stuff, trying to track things, figure out where our risk lies, it's in that export side, international price volatility, these sorts of things. Now, if we take a look at that class 4 is butter, non-fat dry milk. We said before that butter fat is prevalent, which also means that we have more production of it because we also have some investment in that butter space. So butter production, pretty solid. Also, we're, kind of coming into that butter production time of year. This is what we would expect. Domestically, where our use more or less flat in range, nothing standing out on that. when we kind of take a look at a year over year by month basis. Ending stocks are getting a little tight. Why? Exports. So we've been moving some exports again. March 2026 year over year is plus 85%. Big number, right? So we're moving product internationally. I'm working what I'm going to be interested to see is that I'm working on a paper on the closure of the Strait of Hormuz. And by and large, we didn't move a lot of dairy product through there except for butter. So as we kind of take a look at this change by month, it's been decreasing a little bit. My question is, and then I'm waiting to see is, hey, where has there been enough time in the data legs here to see any of that come through in the numbers? So I think that'll be an interesting metric to watch and see what happens there. Non-fat dry milk. If anybody out there knows exactly what's happening in this space, you do, please let me know because we'll kind of break out in a bit here where some of these signals or indicators might be. For a while, we thought maybe it was all export driven. You'll see in some of the data that we'll have later. I'm not certain that this non-fat dry milk price run up is exclusively from that. Our production up a little bit for March here, ending stocks. We'll call that in range. And our domestic use seems to be where this non-fat dry milk portion numbers seem to be coming in that is driving that up. I'm not going to give away the story or any hunches where I think that's coming from yet, but I think that space is interesting to say the least at the moment. On the supply side, what's happening? We're still adding cows. Why are we adding cows? Because we're adding processing. That's really been the driver on that number. Our bottom dip in end of 2024, beginning of 2025, where cow numbers were flat. They were flat there because there wasn't a home for additional milk, right? As soon as processing came online, we've just kind of hockey sticked up and to the right. I was asked this morning when I think that will end, and my answer is when processors have said, all right, we're good, right? Once things have been ramped up online, everything kind of status quo, that's when, in my estimation, when we'll see those cow numbers kind of flatten off. And again, not to give away some data information we'll talk about later, but all of these cow number increases have happened during a time in which there's been a lot of headline news about heifer replacement inventories being tight. So there is some data that's lacking or hard to get or decipher within that, but we'll touch on that as we go forward. But I do think it's an interesting point of conversation at least. And then if we take a look at where monthly milk production has been coming in, we have more cows. The cows that we have are increasingly efficient. What does that mean? It means that monthly milk production, of course, is continuing to go up. So this slide isn't really a shock to anybody that's heard me talk before, but our butter, fat, and our protein keep going up and up and up every single year. Again, we set a record for Q1 of 2026 for components. For our year-to-date butter fat, we're at 4.42%. Protein is 3.41%. That's the highest quarter one on record. For 2025 full year, our fat was at 4.3 and our protein was 3.34. So, we just keep going up and up and up. The good news is that pretty soon we won't need a processor. It can go right from cow, come out as enough solids that'll be like yogurt and it'll go right on the shelf, right? So we won't have to worry about make allowance, we won't have to worry about any of it. But we're still a ways off yet. I don't think we're even close to where the full potential is yet of producing solids either. So but one thing I've coined this is this phantom supply. So we're seeing greater changes in our solids component production than we are in milk volume, right? So we even have months where milk volumes can be negative, but the total volume of solids shipped are positive, right? So that means a few things. One, we need fewer cows to produce the same number of solids we had before, which means that we'll fill processing capacity faster than we have historically. And that, like for this year-over-year change, our most recent numbers, our milk production wasn't really all that much different, but we still had a pretty good increase in our solids production. So, what does this mean when it comes to the dollars and cents? Well, component prices are, as I think anybody on this call knows, have been more volatile over this last period of time, right, than they were a decade ago. But one thing that is kind of the more recent trend we're seeing is that this inversion period. So historically, protein prices are generally above butterfat. Starting 2022, 2023, we saw that switch. And butter, I mean, people that have had that chance to sell into that class 4 market know this really well, that those prices have been solid and hanging in there for a while. Well, we've kind of seen that inversion happen here. And then recently in 2026, it looks like those two lines touched, did not cross, and then started to deviate again. So again, where did that come from? Looks like cheese exports, and then we're just long on butterfat. So as that non-fat dry milk portion comes in, that's really been holding up that class 4. And then the butterfat has been kind of the dragging it down or equalizing that run up. So the big question too on that is, what does class 4 look like once this non-fat dry milk story is kind of sorted out, figured out, we understand what's happening, and if there's any price softening there, right? So because if butterfat's coming down, that's the only other option to keep that price up. So it'll be interesting to see, that's for sure. What we're definitely seeing on those cow numbers is that the cows are going to where the processing investment is happening. So we are kind of seeing this reshaping of the geography of the U.S. herd. On this slide, I have stars next to the top, historically the top milk producing states in the country. So Wisconsin, Texas, Idaho, New York, and California. What's interesting is that take a look at California. Their increase is pretty small. And actually, before this new data came in the previous one, they were actually down. So they kind of keep bouncing back and forth, where for a long time, that was the part of the world where we saw a lot of these increases in cow numbers. So I'll have some information that shows kind of where these drivers are coming from and what this means. But really where that processing investment is happening, we're seeing pretty tight correlation with where these cow numbers are increasing. So just based on this, you can make a pretty good assumption. The top leaders in April 2025 to April 2026 increases in cow numbers are Kansas, Wisconsin, Texas, Idaho, Michigan. You'll see pretty soon here that those are also places that have a lot of investment. The one that I think is going to increase a lot coming up is New York, because of the big investment that Chobani has out there. And then, so they'll be pulling some milk there. And then also, my guess is there'll be some spillover into states like Michigan as well. So it'll be kind of interesting to see what happens there. I think all of this story, though, is kind of underpinned on genetics and dairy herd. So we're going to spend a little bit of time on that. And if you're talking about genetics right now, at least, you really can't talk about that without talking about beef on dairy as well. So beef on dairy has really become almost shifting into a structural form of income on dairy farms versus let's say, nice residual that it kind of once was, right? So I think that deserves some attention and to look at here as well. So if we call this the genetic revolution, what's happened? We've gotten higher components, right? Heritability of butterfat and protein is about 20 to 25%. So, we've seen that come through in the genetics and the genomics, things like this. And, as we saw before, components keep increasing. The other side of this is that beef on dairy side, we are getting those higher calf revenues. And also, why are we doing that? A few reasons. One, as we get better management, we have more longevity. As we have sex semen, we don't need to breed as many animals to get the same number of replacements, right? I mean, if we figure historically, 50% males, females, using conventional semen, well, you're going to take your breeding capacity needs to be larger to get the same number of replacement animals. Well, with sex semen, with all of the other management practices we're having, you don't need as many of your animals to be able to produce, in fact, fewer replacements than what we needed historically. I've heard numbers as low as like 20% needed for replacement rates on some really efficient herds. So which means that you have an awful lot of animals that you have reproductive capacity in order to make terminally bred crosses. So we're about 8.1 million beef units on dairy. We have 10 plus million genomic tests out there. All of this kind of leads into, right, kind of the situation we're at. I get asked all the time, when does this change, right? Are we going to continue breeding for components? If we're long on milk fat, why keep breeding for it? If that looks like it's going to be the trend, what's going to happen? Same on the beef side. Like, hey, in my estimation, it's not a matter of if the beef market ever corrects, it's when. So if and or when that happens, are we still going to be breeding this many beef on dairy? My answer is, let's just look at like some basic repro timelines, right? If all of a sudden today, producers had a different clear path to breed for, something else to optimize, right? And they made that shift. Well, if they made that breeding decision today, it's going to take 5.5 to 6 years before that animal leaves the herd, right? So this ship has sailed, right, for at least the next, say, 5 to 6 years. And honestly, I don't see any other clear other incentive that producers would be shifting to or breeding towards, by and large at least, that would incentivize them to make a different decision. The one thing I do want to talk about or note here quick is that one thing that kind of gets buried in the headlines or lost on this whole beef on dairy discussion is what we call path dependency. So every farm is different. Every farm has their unique decisions, their unique timelines, all of this, right? What does that mean? It means that not everybody, one, is breeding beef on dairy, two, has the ability to, and three, does it in the same extent, right? So if you just recently went through a herd expansion, and you're trying to build up your replacement inventory, are you going to be breeding for beef or are you going to be breeding for replacements? Probably breeding for replacements. Did you have a string of bad luck in the past and you need to, maybe some bug went through, death rates went up, something like this, right? And you need to increase your inventories. Well, what are you going to do? Likely do that first. So, I think when people talk about the beef on dairy discussion, it's easy to pick a number, anchor on that, and then kind of wave your hands and say, yep, that must be it. But some additional information on this as we proceed, but I think that that concept is very important. That every farm is very different. Some might choose, if they're a higher genetic herd and they're selling replacements, that they're not utilizing any of these terminally bred crosses. So I think that we don't want to lose sight of that every farm is very, very different. In the data that's come through, what's the trend? Sexed on the best and beef on the rest, right? We're using our highest genomic animals and our highest genetic value creatures that are getting bred to make these replacements. As we do that, what do we do with the rest? Again, breeding them to beef. So we're about 10.6 million sexed dairy units, about 64%-ish of domestic dairy. And that's up about 4,000 from 2024. So again, top tier genetics into those heifer replacements. We're about 36% of domestic dairy semen use is at conventional units. And then 8.1 million is that beef on dairy. So that's about 33% of all services. But what's interesting though is that we're about flat year over year. So the question I have is, like, have we reached where we're going to be at? I don't know. As we see count numbers increase, there is a potential that maybe we see some of these maybe a tick up here for 2026 once those numbers come in. But if we take just on average and we look at our average herd, national herds, cull rates with these services, according to my math, it looks like we still have enough replacements at our average cull rate. I realize that's a controversial statement, but just the averaging math that I've done, that does seem to be the case. Is our margin for error less? Certainly. But it does seem that we are still having, enough replacements being added to the herd. And again, our production, our ability to produce these additional heifer inventory has not gone away, right? I mean, the cows are still there. If there's a lot of room for shifting yet, right? If the economics dictate that, hey, it's better to go breed these animals on sexed dairy units versus sexed beef units, I'm confident that the dairy producer would respond to that. This is just kind of a nice graphic of the semen sales strategy or trajectory over time, where in this blue or gray, we have the domestic dairy units, and this red is the domestic beef. And then, as we get to 2015, 16-ish, all of a sudden they start to widen out. But what I do think is interesting is that if you draw a line across the top, we're more or less flat, right? We see some increases year over year, but in total, we seem to be kind of range bound. Beef semen is up about 9 times since 2000, and about 37-ish% of the 2025 total, sorry. But the question then is, what goes in the semen tank? Well, if we kind of take a look at 2023 compared to 2025, in 2013, about 7% of our semen tank was beef. Now it's about 37%. And also, let's take a look at Holstein. So actually, excuse me, let's look at our colored breeds first. We had Jersey at 3% or 11%, other breeds at 3% in 2013. In 2025, we have Jersey at 7%, and cross other make up about 5-ish%, right? Well, if we've had all of the increase in components and solids over this period of time, which breed would we attribute it to? According to this information, the Holstein herd, right? The Holsteins have increased their genetics enough that they've been the driver in the component production that historically we were looking at the color breeds for. So I just think that's kind of an interesting transition that we've been going through, and I think it does speak a lot to the genetic progress that we're doing. And then, of course, genetic potential is nothing if it isn't valuable at all if it's not realized, right? And the other half of that story is the feeding advances. About 55% of milk uh, composition variation is genetic. About 45% of it is nutrition and management. I don't think we're anywhere near the full genetic potential of the U.S. dairy cow yet. As we kind of take a look at the nutrition, the management things, they're only going to continue to get better. Um, uh, I think there's a lot to talk about yet on, things like high oleic soybeans, and some other nutrition things. If people are interested or have questions here today, we can kind of dive into that more. But I know that can be almost an hour discussion in and of itself. So we'll leave it to the end if somebody's really interested in that. Um, but this is where I want to spend a little bit of time. So what I did is I just kind of modeled out what beef revenues are and converted it to a per hundredweight of milk equivalent, right? So we're not talking about hundredweights and values of beef. We're not talking about pounds of beef. We converted everything to hundredweights of milk, right? And then what I did is I modeled different scenarios of breeding, terminally breeding your dairy herd, right? Based on beef semen, heifer inventory, cull rates, all of these things, and kind of came up with what I call an envelope here. So the envelope is that tan area that kind of surrounds that red line. So as we kind of take a look over time, the red line is my model. The blue line is the ERS for the United States. I took their data and information and then backed it into where revenue per hundredweight of milk would be. And then I did the same thing with Wisconsin, right? So based on their standard average assumptions and information. Now, keep in mind that this is not these three lines are measuring different things. My model does not account for replacement costs, so that animal replacement costs, that new heifer costs, if you're buying cows, this sort of thing, the ERS number does, and a few other things like this. So don't think that that I'm trying to say ERS is wrong or anything like this. I'm using ERS as kind of a baseline assumption that if we're not doing very much beef on dairy breedings, right, we're probably closer to that ERS number. Where if we are making deliberate beef on dairy breedings, then we're probably likely in that envelope range, right? So the question becomes, well, what is that envelope range? Well, on the bottom side, beef for my estimation for 2026 looks like it can contribute around anywhere from $3 up to $5.50 per hundredweight of beef revenue. But then the question is, well, what if you were closer to the ERS numbers? What if you're somebody that's focusing on building your internal replacement inventory versus beef on dairy cross? Well, it's not on the slide, but if you kind of extrapolate out, you're much closer to that like $2.50 range, right? So what does that mean? It means when we see these numbers on how much beef is contributing to the bottom line on a dairy farm, big takeaway, at least from my perspective, is that it's incredibly variable, right? If you're on that lower side, where are you capturing that increased value in the beef market? Cull cow sales, right? That's a lot of it. And then also your traditional bull calf sales, things like this. So again, anywhere from $2.50 all the way up to $5.50 based on, again, all of these decisions. There's a lot of management decisions wrapped in here. If you're depending on your cull rates and your replacement rates and all of these things to create that window. So, headlines that say $5 per hundredweight of beef revenue on that milk check, I think it's certainly possible. And I'm not saying that they're wrong. but I do think that there's a lot of assumptions that are behind that number, right? And I think it's important for us to know that. But if we just kind of take this midline value, right, and use that for our kind of assumptions going forward, let's call it $4-ish in added value to that milk check. So then what I did is kind of take it a step further. And then I looked at this by year and then broke it down by cull cow values, calf sale values, total beef revenue. And then I took milk revenue plus beef revenue to come up with a total revenue number. And then looked at what percentage of total revenue now is coming from that beef marketplace or taking advantage or utilizing that additional value stream. Well, not uniformly, but more or less from say at least 2017-ish until now, pretty much increasing year over year for almost all of these columns. What's interesting though is that we did not see a big change in our cull cow revenues until about 2022. And right now, my forecast, at least for 2026, is we're about $2, call it $2.50 in cull cow revenue to that milk check, which tracks pretty close to that ERS value if you kind of extrapolate that out. So, I think those two numbers are obviously related to each other, but I think track pretty well. But it's that, and again, this follows that red line where if you are choosing to do some beef on dairy breedings, that this is where that number comes out. And then, for 2026 forecast, the total beef revenue is about $4.17, which is almost 17% of gross revenue on dairy farms. 17%. That to me is a very large number considering that we came from single digit percentages for a very long time. I mean, normally you were at, let's call it a range of 7 to let's call it 5.5, right? 5.5 to 7% used to be that gross revenue number. Now it's at 17%. That's certainly noticeable in a lot of operations. So I think that it's important to think about your risk exposure to that as well, right? Dairy markets are already volatile. If 17% of your revenue is coming from this source, I think there's also some volatility there that you may want to keep in mind.
Leonard, real quick before we move on, we had a question come in that said, what is the tipping point for heifer sales? How high is too high?
I wish I knew that answer. I really do. And one thing I've been kind of playing around on the math with is that is to figure out how much of the value of the heifer is being derived from the beef market versus the dairy value of it, right? Because let's say you take a cull cow and a calf to market and sell it, right? So you sell that, and then you add a little bit to boot, and then you buy a heifer. That's kind of been how it works historically, right? And I'll be honest, I haven't ran the numbers recently to know exactly where that falls, but maybe we're about the same, right? Maybe your to boot price is about the same as it had been historically. I'm not saying it is, but I do think it's those numbers are probably close enough to think about. But the issue, I think that I'm not hand waving away, but is if you're looking at purchasing heifers to grow, right? If you have to go out and buy them versus maintain, that's where I think a lot of folks are finding the pressure on those heifer prices, right? Is the outright purchase of the replacement. So realize I did a very bad job answering that question. Hopefully it helps, but yeah, I don't know, and I don't know how much. I haven't really, so finding especially Wisconsin specific numbers that are good enough to specifically pinpoint and track is really difficult. So I have to create like bands and ranges and kind of extrapolate out. So I don't know how close exactly or precisely that heifer number has been tracking to that local heifer number to that local beef number to say specifically. So I don't. To me, that's how I'd come up with that upper end, right? Is if we've seen that heifer price drop with the beef price, then we probably know. If we don't, or if we haven't seen that yet, then I don't think we found our upper end. Yeah, good question. Anything else come in?
Yeah, we actually did have another one come in. Even before the recent protein craze, our dairy industry has relied on non-fat dry matter in the export market. For now, we are benefiting from cheese exports, but will that last? My real question is, will the demand for protein, whey, and NFDM drive the milk price to the farmer?
We have information on that. So good question
Perfect.
coming up.
Awesome. We'll get
Yep.
into it.
Yep. It's a good question.
Wonderful.
I think it's a very good question for a lot of reasons. So we'll get into that. Demand and anything else quick before.
Nope, that is all for now. Continue on,
Perfect.
Leonard.
So demand and processing, this kind of gets at that. I indexed consumer demand with base 2010 per product. And then I also indexed, so you can, dairy, there's never a simple direct answer in dairy, right? Where it's always infinitely complex. So in order to paint a picture of this, I also indexed total per capita dairy demand in milk fat equivalents and in skim equivalents, right? So the milk fat equivalents are those the red dots on there, or the diamonds, and then the purple dots are the milk equivalents in skim. But what I find interesting, we're just going to start with those dots first. I didn't draw lines between them because I figured it would visually be a little difficult. But like in your mind, you can kind of see that since like base year 2011, we've milk fat equivalents have kind of bowed up a little bit, peaked in 2021, and then started coming back down. And now, and then skim did the exact opposite, bowed down a little bit, um, kind of hit the bottom at about the same time, around that 2021 mark, and now have come back up. And now they're kind of touching yet again, right? What does this mean? More or less on a total equivalence basis, yeah, sure, fat was going up a bit, cheese went down a bit, it's come back up a bit, but more or less, we're flat, right? What's changing is how we're consuming that, right? Fluid milk, pretty much straight line down. What has went up? Butter and cheese. Cheese recently kind of leveled off. What else is going up? Yogurt's having a moment, right? Cottage cheese is having a moment. And I don't mean that to say that it's temporal and that it's not going to continue, right? But like those are the things that have been increasing. So how we're consuming our dairy is changing, but domestically we're more or less flat. So what does that mean? It means that when you're thinking about this from a product space, is that a lot of shifting into products or between products, or right, like dairy is getting very product specific in the way that it's being consumed. Also, if domestically we're flat, that means from the more commodity view perspective, where does any additional have to go? In anything, exported, right? Unless you're looking at developing into a very product specific thing, domestically, right? Otherwise, by and large, you're looking at your export market. So U.S. cheese, its cheese of exports have doubled in a decade. So again, about 10% of the U.S. cheese production. Where does that go? A lot of it goes to our very near neighbor, Mexico, followed by South Korea, Japan, Australia, Middle East, and then the rest of the world. The um, the one big thing on this to think about is that in July, we are starting USMCA trade negotiations again. Um, Mexico and Canada are our biggest trade partners for dairy. So it's I think a good thing to watch, right? To see where some of that goes, where some of that lands. Because if on that cheese side, a wrinkle in trade agreement could mean a big difference in cheese prices and exports. So cheese exports have what been kind of holding up some of these values. Um, let's talk about the dairy processing for a bit here, quick, and then we'll get to some other information answering the other questions that were asked. I created this graphic here, and I tried to get as close to that $12 billion as we can. But some of that 12 billion isn't perfectly announced, especially if it's a private company where they don't have to. So we kind of extrapolated out. I realize it's very busy. There's a whole lot of information on there. Feel free to squint, take a screenshot, do what's needed. But a few things I want to point out is that if you kind of make a T across the country, north, south, east, west, they're pretty much in those two lines, right? Also, the colors. So red is cheese, blue is fluid, yogurt is green, and then the yellow is butter, powder, ingredients. Well, we can see that some of those in the bubbles, the size of the bubble is the size of the investment. We get dairy or cheese is kind of clustered in certain geographies, right? Chobani is kind of the outlier geographically for their yogurt plant, but we do have a few other yogurt plants here, kind of in somewhat of the Midwest. But cheese is also kind of has its own geographies here. And as we mentioned before, if you kind of take a look at that T and look at where cow numbers are going, they're following pretty close to that T, right? So in order to kind of paint this picture even more, what I did is I just took a look at where mailbox prices were by region across the US, and kind of ranked them. Now, mailbox price is not a function of profitability, right? Because every region has their own different cost structures. Think feed availability, right? Some places they gotta put wheels under a lot of feed in order to get it to where it needs to be. That can get expensive. All of these things. So, but what's interesting though is if we take a look at some of our higher pay price states versus kind of our mid states to our lower states here. And then we graph them out kind of on a scatter plot based on mailbox price and um, uh, change in dairy cow inventory. We can kind of put them in four different quadrants. So the upper left, if you're up there, you have a shrinking herd even with high pay price, right? On the upper right, you have a growing herd with high pay price. On the bottom right, you have a growing herd but low pay price. And then in the bottom left, you would have a shrinking herd with low pay price, right? Well, where are the cow number changes kind of happening? Um, Kind of clustered in that middle space, right? The far outliers, Idaho and Texas, what's happening there? That's a big processing pull, right? They historically have lower pay prices, but they're growing because there's the processor demand there. Taking a look at like New York, Wisconsin, Michigan, we're all, or Wisconsin specifically, very much in the middle of the pack on pay price. But kind of we're seeing that investment and we're seeing that cow growth happening there as well, right? Florida, really good pay price, but it's not as conducive to dairying and different cost structures. So even while they have a high pay price, it doesn't necessarily mean that they're going to be growing their numbers without that additional processing capacity as well. So now we take a look at this processing capacity. Where does it break out to? And again, I realize these numbers don't add up to 12, but again, we can only go off of what's announced specifically. I can find totals for some projects and then extrapolate back out, but to get the exact details. But where is this investment going? Cheese first, and then on that fluid or the cream side, don't think fluid milk. A lot of that is ultra filtered and value added fluid products, right? Some of it is fluid milk, like for example, Walmart, I believe. We'll go back here to see for sure. In There was, yep, one in Idaho and Fairlife in New York and Hood in New York have some fluid plants, right? But think of it more as your specialty products. So followed by yogurt, butters and powders, and then finally ice cream. So 50 plus projects across 19 states. Also, the question on demand, right? High protein whey, non-fat dry milk. I think we certainly need to talk about those and kind of figure out what's going on here. Well, high protein demand, it could be, I'm not saying it is, but it could be structural. Anybody that's been around for a little while in the dairy space can probably remember the last time cottage cheese was in vogue, right? And I am about the worst person to ever ask um, uh, consumer sentiment, consumer decision, economic stuff. I am the worst predictor of what consumer choices are going to be. Go to TikTok for that because it's probably going to be better than me. So I don't know if like high protein is a craze on the consumer side, if it's here to stay, if what the deal is on the pure just consumer preference side, right? But what I will say is that the GLP-1s, the weight loss medications, should theoretically have a much more structural staying power in this high protein demand pull than what we've seen previously. So since 2020, we've seen almost a threefold increase in protein claimed food launches, right? So like things that say, protein, high protein water, high protein candy, high protein, you name it, toilet paper, I don't know, whatever, right? All, has increased threefold since 2020. It's reported 70% of Americans want more protein, and about 12% of the US population is on the GLP-1 medications. So the big thing there is that those patents are set to expire in other countries coming up fairly soon. So in 2026, actually. So that'll expire in India, China, Brazil, and Turkey. And those populations do have folks that, if you look at demographics, would say they probably have an uptake in the use of that medication as well. So what does that mean for global demand for this? I think there's an argument to be made that it would be increasing. But high protein foods are not all created equal, and we'll spend just a little bit of time on that kind of as we look at this high protein whey phenomenon or complex that's going on. So when we take a look at total whey production, we're at about 200 MMTs, million metric tons of liquid whey produced globally each year. About 5 of that gets into dry whey products, and about 0.9 gets made into these higher value protein products. So right now, what's happening, at least in my estimation, is that we're having a bottleneck in the processing, not in actual availability of raw product, right? So milk, you take your raw milk and then coagulate it. From that, basic food science class, we get liquid whey and you get your cheese and curd, right? So from your liquid whey, you get 2 different whey streams. You have your sweet whey and your acid whey. Acid whey is from the Greek yogurt, cream cheese, things like this. That kind of goes different system outside of where a lot of these high protein products are coming from. So if you go to sweet whey, and then you kind of have 2 options. This is, again, a broad generalization, but for the sake of argument today, I think it paints the picture at least. We have 2 options. One, go to spray drying. So SWP, and you get about 12% protein product on that, or you go to ultrafiltration. Question is, how does this feed into class three price? Well, the NDPSR price is what's used to survey weekly averages to get the whey price for that class three calculation. So where in this chart does the class three price come in, or what feeds into that? Right there, the NDPSR price on that spray dried whey, right? So again, about 12% protein, about 1.6 dollars per kg. But if we go to processing it further, this is where we run into that ultrafiltration bottleneck. It's a bottleneck. Why? Because we could spend the next half hour on that alone. But basically, it's capital intensive, right? It's demand based in that we have this lag between demand and building capacity, because you have to remember historically this whey was not a source of profit. The goal was to minimize how much money you lose on whey, not necessarily look at it as a profit driver or profit center, right? That's shifted more recently because of these new co-products and linkages and things like this and product development that's happened. So once you get to UF, if you kind of flow one way to the right, you get your whey permeates, your lactose, your really specialty fractions on things. And then if you go to the left side here, you get your high protein whey products that are in the headlines right now. So you get your WPCs, whey protein concentrates from 34 to 70% protein. Right now, I have those in that orangish color because the availability for those are tight-ish, but they're still available. But as we kind of take a look at the other products, we start to get into red boxes because the supply of those are tighter. And they're also the higher protein level products. So WPC 80% protein, shortage on that. If you want to process further and go to diafiltration, you then get WPI, whey protein isolate, which is 90% protein, or you can process further into WPH, right? The big takeaway from this is that as you go down the chart, the value increases, but also so does the cost of processing it, right? And so do the volumes of these things, simply because historically, a lot of the demand was more or less flat or satiated at that point. So again, this kind of just shows the same thing, but in a different visual with the prices kind of at each level. As you go down, you get increasingly expensive, higher protein levels, all of this, but also our shortage or our tightness increases too. So WPI, kind of starting at the bottom of the graph, is WPH, WPI. That's really where our shortage is. Those high protein things, the higher priced ones. Also, those are the ones that if you're going to put in a food product, right, those are the ones that you're going to want to be grabbing and utilizing. So, but as you go up that ladder, it's more and more available. Well, how has the US changed or responded to this? Over the last, call it decade, we went from about 70% commodity grade to now about 55% commodity grade production, and we were at about 10% of the high protein whey production, and now about 20% of our whey is produced in those products. So it is happening. We will get more, especially as cheese processing comes online, right? But it's just kind of this mismatch of timing and lag in the marketplace right now. Just a few minutes on non-fat dry milk. So NDM globally is up. But what's interesting is how much US price is up relative to the rest of the world, right? So normally we can track with Europe and South America, but we are seldom this much higher, right? And because of that reason, I would estimate that we're actually maybe something is going on domestically in the non-fat dry milk space and not internationally. and maybe we're just picking up sympathy bids in that international marketplace, right? If that is the case, that means that our premium in this product will likely go back down. And here's what I can tell you generally what we know right now is that global S&P is a little tight. Europe production is essentially flat. US exports are strong. And the WASDE has raised the non-fat dry milk price twice recently here. So the big thing on what's unusual is that we're now leading the global prices. Um, Really not something you would normally expect. Um, Also, butter moves the opposite direction globally, and stocks by and large globally aren't unusually low, right? So, my guess is that there's either some inventory holdup or a kink in the system right now that I know there's some different speculations out there. I'm not going to share them, but like there's certain just rumor mill sort of things that may say, hey, like there's just a holdup in the supply chain, maybe some inventory carries that are getting sorted out, and that if that is the case, then I think we probably could see that correction back. Um, Really quickly, we'll look at some global stuff quick, and then we'll get to the fun forecasting things. On the percent increase basis, we have quite a few other countries that are coming online. Well, not coming online, but increasing. We have Argentina, Uruguay, New Zealand. But really, when you take a look at the total volume that's being increased, I mean, we by far are outproducing them. So if you take New Zealand, Argentina, Uruguay, and Australia combined, um, you know, we're still we still added more than all of the other countries combined for our recent increases here. When we kind of look at if you index milk production from at 2015 and look at where increases have happened over time, I mean, it's the US, right? We're up about 12%. Europe is kind of all over the place. They were keeping up there for a bit and dropped off. They had a lot of things going on, and now have kind of leveled off. New Zealand is increasing as well, but nowhere near to the same amount. The one thing I'd look at or think about here is this red line. So this looks at farm gate milk price standardized across the United States, Europe, New Zealand, which is Fonterra, France, Lactalis, Lactalis, and Germany, right? So we've always kind of been in the pack as far as milk price goes. And then about 2025, we started to see the pressure come down and come closer to that New Zealand price. And now recently, like end of 2025 here, we became the lowest farm gate price milk, right? What does that mean? It means that we're that low cost structure dairy producer that New Zealand kind of once was looked at being. So, it double-edged sword, right? Because higher farm gate prices do translate into higher profitability levels. But at the same time, if we weren't at that price level, we wouldn't be clearing exports. If we don't clear exports, right, then when we get more price pressure. So I guess the hope is that this line continues up and that we all kind of can converge back up a bit to hopefully level out and do offer a bit more farm level profitability here. So to get to a forecast, I want to start with cost. I do think that on a lot of operations right now, there is maybe a bit more of especially the first quarter of this year, a bit more of an economic squeeze than what the headlines are capturing. And I think that when we take a look at feed costs versus non-feed costs, it paints that picture a little better for us. Because it's easy to say that feed costs have gone down, and they have, right? I don't think anybody would argue that. But I do think for 2026, when you look at feed cost, feed costs, especially for homegrown feeds, because fuel and fertilizer have went up. I think that is kind of easy to miss when looking, especially say from end of the summer through 2026 and 2027 farm level profitability numbers. I think that we could easily see homegrown feed prices be quite a bit more when you're doing your own accounting than what our published feed prices are. So I would keep that in mind. But even so, feed prices, if we assume that they've come down, let's take a look at our non-feed costs, right? We just seem every year we seem to just keep ticking up, ticking up, ticking up, right? Everything from finance costs, hired labor, all of these things. All of your, I call them your inflationary responsive numbers, right? As inflation goes up, so do all these other costs. So I think that's where some of that squeeze is coming from right now. And as we kind of take a look at putting all of this picture together, right? Let's look at if we take our base milk price and then we take our overorder premium, and then we take our cull cow price, and then we take our calf price, and we add all of that together, you get the bars on this graph over time, right? So all of those revenue streams together. Well, as you kind of see, as we go along here, uh, the makeup of those bars definitely seems to be shifting, right? And then our we'll call it a teal line is that cash margin, which is that difference between the cash cost and the total revenue, right? So, and that's measured on that right-hand axis. It looks like based on the graph that we're doing pretty good, right? But let's think about our beef revenues. We said before that could range from $2 to $4, right? Well, here, it adds $4 to that 2026 projection. So if you're not capitalizing that at that rate simply because your breeding strategies have to be different, you could easily take $2 off of that, right? So instead of taking a look at an $8 margin, we're at a $6 margin. I think that gets tight pretty quick. And that doesn't account for any non-cash costs. There's no owner draw in there, these sorts of things. There's no capital recovery cost, which means your maintenance, replacing equipment, things like this, right? So as we kind of take a look at where that leaves us, the red lines on these bars kind of show the cash cost line on a fully loaded basis, which includes the non-cash overheads, which if you take out the owner draw and you do include some of those replacement capital asset replacement things, it looks like we are definitely kind of structurally depending on that beef revenue in order to cover where our total cost line would be, right? So as we kind of take a look at what the future curves look like, the two solid lines are our class 3 and our class 4. The dashed or dotted lines are the butter and cheese lines. Butter CME does seem that butter is soft in the near term, but does have some good power coming up behind it later, which is kind of the antithesis to some of this class 3 and class 4 price, right? So if class 4 is coming down and that butter price is going up, that likely means that non-fat dry milk is going to see some softness coming in. And it looks like that at least the market is currently pricing these things to converge a bit. So class 3 peaks at about $18.38 as we get towards fall. And that back half of that class 4 curve is relatively flat around that 17.5 mark. So with that, I'll take questions. Some of the big takeaways, I still think we have some mixed market signals within classes. I do think the non-fat dry milk rally is US specific components. That's not going away. It is going to be the structural change that we see and that beef on dairy does seem to be a margin pillar and not necessarily just a side effect anymore, or a smaller portion of revenue. So I'd really think about in your operation what that means, not only in the short term and how to capitalize on that, but also like in the long term, right? If we don't see over order premiums come back, if we don't have the beef revenue, what does that mean to your bottom line?
All right. Well, thank you so much, Leonard. That was a ton of information in a really short amount of time. We had some great questions coming in throughout our time that we had. But just to wrap up here, wait a little bit in case some questions do come through. But looking out the next 6 to 12 months, what is one indicator you are watching the most closely, and what would change your outlook if it moved?
I think inventories are the thing to watch right now, because you want to capture that residual, right? Production we know is going to change. Exports we know are going to change somehow, right? But that's where I would look. That's what I would watch. And some of the other ones that so much they can capture so much news, right? And like you can think that, oh, exports are doing great. Well, prices should be skyrocketing. Well, if exports are doing well, but inventories are still growing, well, that means that something else is happening, right? So,
All right. Well, thank you so much again for your time, Leonard. I know his contact information is on the screen as well if you have any other more questions. But I want to say thank you to everyone for joining us today here on the Dairy Signal. I hope you enjoy the rest of this wonderful Thursday that we are having and enjoy your last weekend of May this weekend. And so we look forward to seeing you back here next week on the Dairy Signal.